Today, we will focus more on the startups and all the trends that we see there. So hello, Michele.
Hi, Igor. It's a pleasure to be here.
Today's topic, and maybe in this case to have more disclosure to our listeners, can you give a little bit background of yourself, like what you're busy with and what your experience is?
General background on my side. So obviously I'm Michele. I'm coming from a managerial consulting background. I started my career in M&A at first between Italy, UK, and Spain. So my main area of expertise was mergers and acquisition between banks and financial institutions, so financial services mostly. Then I've discovered fintech over time, and I started to move my career into that direction. I've been at first a product manager for an Italian tech company for approximately 5 years. Then I've moved on into fintech, and I've been a senior product manager for an open banking platform in Germany for approximately 3 years, and then moving on to Bunq more recently as a product owner. I started to be very involved in the startup ecosystem in basically 2017, 2018, when I made a first investment in a fintech startup in the UK. That was also very curiously my first exit in 2021. And since that period, I started to collaborate with many different kind of incubators and accelerators all over Europe as a mentor and an advisor to, bring my own experience and skills to newborn early stage fintech startups in the market. So this is what I'm currently doing and trying to help newborn companies and trying to invest on them when I can, and trying to get as much knowledge and experience as I can in the fintech ecosystem.
That's pretty inspiring. And for me, it's usually, I see the positions or the activities, which is sometimes hard to combine. And in this case, it's quite interesting that you have the combination of the as an investor and also the product manager. What do you think the values that gives you an ability to operate with those two kind of different, but in the same way, combined positions?
Yeah, I think that there are a lot of investors out there that are coming from different kind of environment. Many of them coming from very strong financial experience, or there may be the investment banking or consulting over time, getting to know one side of the medal, the one that is more on the economic and financial side. But getting your hands dirty with the technical side, so being a product manager and having that kind of experience, filling fintech applications and releasing fintech application, you get to know the real problems we have behind the product and behind the growth of a company. So I think that kind of experience is very helpful when you are kind of evaluating new opportunities and new investments. So this is the kind of approach that I always use when trying to evaluate an investment. So I always try to understand, okay, if I were in their place, what would I do, and what would I invest my time on? Which kind of feature I would try to release, which kind of things I would try to bring to the market. So that is usually pretty useful because it put me in a place where I can say, okay, this is something that actually makes sense and people actually want out there, or maybe this is something that is just very, very interesting, but no one out there actually wants. So it gives you an edge, in my opinion, when trying to understand good investment and trying to understand what startups are actually doing in the market.
That's definitely true. Being the product manager gives a really good exposure what the digital product is about and how potentially it will perform on the market. And maybe we will start cutting like from another end. And I'm usually thinking about current fintech projects. And I think, and we see that the market is shifting to pure digital products. Like maybe 15 years ago, it was a really big question, even in UK, if the digital banking is going to be dominant way how the people interact. Do you think there is still space for the fintechs which are not purely digital or have the physical presence? Like, is it still a market where everything is shifted to the digital and sitting in your pocket within your mobile phone?
Well, that's a very good question. So, for example, in traditional banking and in financial services in general, we saw a strong push for the dematerialization, for example, of branches. Many traditional banks do not have branch anymore, or they're cutting them down a lot. So I think that kind of push is absolutely critical, and it's absolutely present nowadays. At the same time, we saw, for example, digital banking, but also, different kind of fintech startups always pushing under that point of view to bring, digital services in the market. And the idea of having, a physical product in financial services and in fintech today, it's kind of hard because there are a lot of things involved, from cost to operations to personal. So it's kind of hard to see a future where you can actually bring a physical product into the market in this specific sector. But at the same time, you could have said the same basically for AI a couple of years ago. And right now we are seeing different kind of hardware product being, bring to the market that are physical products. So I would say that the real answer in this case is you can never know under that perspective. I would say it's pretty hard in fintech, but there are other verticals where that is actually possible, when you can see physical product being released into the market, even if we are in a purely digital world.
It kind of overlap with my understanding that right now, potentially the physical items in the fintechs, they own marketing and more perception of the customer. Like even this movement with the metal cards with the digital banks, that kind of gives a sense that something is solid, and it still overplays with and overlaps with the marketing in the application. Like you are getting something exclusive as a specific level. So thank you for the highlights. And I would like to maybe explore a little bit of your path as an investor, because I think this area is not well disclosed to someone who's working in fintechs, or even for the people who are overseeing fintechs from the distance, because usually how the decisions are made and what is the process is not really well known. So can you tell us what was the path and your experience as a first investment, your personal experience?
I have an interesting story about it that is around my first investment ever in a startup. Basically, at the time, I was working in a consulting company, a very well-known consulting company. And one of my former colleagues was coming out of the company to actually found the fintech startups in the UK. And we were discussing, about the pros and cons of founding a company and what he was going to do and everything else. And he told me, yeah, it's kind of an interesting idea. I'm really focusing on this one. I really believe in this kind of idea. You should invest something on me. I've never invested at the time. It was like 2017 or something. And I've never invested in anything rather than, the stock market or everything. And I said, okay, let's give it a shot. Let's invest a couple of bucks, a couple of thousand. Let's see how it goes. And I've invested in that idea. And to be absolutely honest, I got totally lucky. It wasn't like a big reasoning or a big, rational or investment thesis. It was just a person that I know, that I was, trusting in his skills and everything else. And I said, okay, I'm trusting him. He said it's a good idea. Let's invest something. Investing in that idea, and 4 years later, something like that, they did a Series A, and they gave the possibility to all the investors to come out and to sell their shares. And I did. We basically did the first exit in that case, and it was a huge amount of return in terms of return on investment. In terms of percentage, it was a huge deal, an amazing deal. Of course, it wasn't enough at the time to retire and live off of that investment, unfortunately, but it was an amazing experience under that perspective. In that case, I got totally lucky, but it was like the first step into the door. And it gave me also the experience of understanding how those kind of things works. So, for example, having the possibility of having a liquidity event from a startup is not that common. It's something that happens only in certain scenarios, and it's something that not all investors, used to, So it's kind of a different experience. At the same time, you have the constant, up and down of a startup. So sometimes you see the positive side, you see numbers growing. Sometimes you see, the worst part of that world, number going down, layoffs, all of those kind of things. So it was a very, very interesting experience in that case. And after that, I started to, being more and more involved in that ecosystem, and I started to evaluate more and more companies. So every time that I was talking with the new startups that I was, for example, mentoring or advising or evaluating a new investment, I was trying to put myself in the same place, in the same kind of position, trying to understand with the kind of competencies and skills that I had that could perform in the same way or follow the same trajectory that I saw, last time that I had an exit. So it's a very interesting experience, to be honest. And I think that over time, I try to shape the kind of investment thesis that I had around startups and around founders mostly. So I try to be very, very early in those kind of things. I try to invest as early as I can. So early stage, even in the friends and family round, if possible. I try to focus a lot on the founders. So I try to invest in exceptional people that are going to find a solution in a way or another. So that's the best way that you can do, at least in my opinion, when investing in those kind of things. I also try to invest on products that are having an impact on final users' life. You can have the best system in the world, the best product in the world, but if no one out there is going to, use that product or find it useful, you're never going to be successful. So you need to find a way to impact on final user's life, in my opinion. So I'm trying to shape my thesis around those two or three things that usually works pretty well in the end. But at the same time, this kind of investments involves a certain amount of lucky and a certain amount of case, so you never know what happens in the end in the market.
Yeah, that's definitely true. And I remember those sweet times before the COVID, because everything was
Yeah.
growing really fast. It was still a gray area, like if the digital will dominate. I remember in 2018, we were releasing the banking challenger bank in the United Kingdom, and we were reading monthly reports about customers shifting to the mobile phone usage rather than going to branches. So it wasn't really obvious, but I think the momentum was there. I think I would like to dig a little bit about this difference between institutional VCs, because you mentioned the round A and then investments from the funds, because a lot of people, I think, kind of overestimating and assuming that this initial stage for forming the company, formatting the idea is not feasible for them. Like, if I have an idea, I have something, how do you think, what you would say to the founders, like what they should keep in mind while they don't have the proven business model, they don't have retained customers, like what they should focus on to have an ability to find the angel investors and non-institutional investors, basically?
So take in consideration that, in my opinion, not every startup, not every founders actually need VC money or institutional money. And mostly today, with the kind of tools and with the kind of let's say help that we have, for example, from AI, you can actually build the business without a huge amount of money, and you can actually bring something into the market without the need of having, a million raised in a round. Okay, so you can actually build your own MVP, release it into the market, try to grow it organically, and show, that kind of metrics and the kind of growth to the market before going to find funds. Okay, so taking that in consideration, I think that in the very, very early stage, when you are, pre-revenue, pre-product, when you just have an idea and maybe a team, you need to take in consideration that people that you're asking money to are investing on you. They are not investing on a business. They're investing on you because maybe they know you, maybe they trust you, maybe they see something on your idea, but they're mostly investing on you. So this is also why you usually call that round a friends and family, because you are talking with the people around you that can actually invest on you because they know you. You're not going to talk with very structured investors or very, professional investors. You're talking mostly to people that know you personally. Okay, so that is usually the first amount of money that can actually bring you up and give you the fuel to actually build the product itself, release it into the market, and maybe spending something on advertising, on acquisition cost, to actually having someone trying the product. And then the next steps, when you're going to proceed, seed, maybe one day to Series A, is actually growing that kind of model to find the product market fit and to grow it exponentially. Okay, when you're reaching that level, we are talking about, from time to time, business angel, sometime also institutional investors, so VC. And to people out there that are starting that path right now, I think that the most important thing that they need to take in consideration is that those kind of investors are very, very different from the one that you find in your friends and family, and they're very different from the ones that you find usually on the market. So they're not stock pickers, they're not big funds that are investing in public equity. They are private investors, institutional investors that are investing in ideas and in companies that are private, that will probably remain private for a long period of time. So we're talking about people that can actually influence your trajectory over time, that have way more experience and more skills than you do in those kind of things. So you need to understand what you want to do and what you are going to benefit from that relationship, because it's not just the money. Money is part of that relationship, but it will come also with a lot of connection, network, experience, skills. So one of the best things that, in my opinion, founders can do is to find the right investors for their growth stage and for their idea. So a couple of examples here. There are very good funds in fintech, both in Europe and in the US, that are very well known for their network effect. So they invest money, of course, in pre-seed and seed, sometimes in Series A, but the kind of value that they can bring to the table is the network of corporate client or financial institutions or very well-known people that can help the idea to grow and to become something bigger than it is actually. So some names are, the Sequoia of the time, the A16Z, Andreessen Horowitz. Those kind of people have kind of a unique network that can bring you from 0 to 1 in a second, and this is what people should find and should try to find when raising money. So it's not just about the kind of capital that you're receiving, it's about the network effect and the kind of value they can bring to the table, that in my opinion is way more important than capital today.
That's true. And my vision, I would say that when you go into VCs, it's quite a lot about the cultural match. And the VCs, they're given the framework rather than just money. Money, it's a fuel, but that's a question, what vehicle, what you are taking and which route you are taking. So someone will accompany you and it should be really well thought and well-weighted decision, I would say. And I will come back a little bit to the friends and family, and the description that I heard before with this stage, it's like a 3F. It's a little bit more like cynic, I would say: friends, family, and fools. And do you think sometimes, because in this case, people are trying, as you described, like founders, they basically put in their own skin in the game by putting their own experience, their own resources to make something to work and prove that they can deliver. So at this stage, I would say to our listeners, usually the company or the startups, they transform it from the vicious into the something tangible, which might be a digital product, and it doesn't have the business model yet. And another question that I usually have is around the contradiction that we usually have in the fintechs, because fintechs are regulated. Most of the cases, if we're talking about financial services, you will need the license, and license costs a lot. So how do you think, and what is your suggestion, how to deal with this contradiction? Because in one way, you don't have a lot of money. You need to prove the business model. You need to kind of bootstrap the product without big engineering team, big legal team. But if you go to the market without license, it's not possible to prove. So what is your best way or suggestion to deal with the complexity of the legal requirements, but also an ability to check the business model?
Yeah, this is a conversation that I have very, very frequently, basically. So, and one of the complaints that I have more frequently from early stage founders, So some of them come back to me saying, okay, I need money to build the product so that I can bring the traction to the market. And in order to bring the product to the market and have that traction, I need the license because, for example, I'm doing payments or I'm doing digital banking, so I need the license.
Chicken and egg problem.
Exactly, So, and in order to have the money to build all of that, I need the numbers for the traction. And in order to have the traction, I need the money. So it's, it's a problem, it's a loop. What I usually say to them is that it's true, first of all. So if you want to build something like a digital bank, or if you want to do payments, mostly in Europe, you will need a license. You will need a banking license. You will need, for example, an e-money license. If you're doing crypto, you're probably going to need MiCAR sooner or later. So you need a license sooner or later. And those kind of licensing are pretty expensive. They can either be expensive to have the fee to actually get the license, or they will probably need, for example, someone internally in the company that need to be in charge of that license. For example, with MiCAR, you need a compliance officer, and we spend a lot of money in a compliance officer in Europe. So you will need those kind of things. But at the same time, what I usually propose them is that you are going to feel needs in the market, So why do you want to, for example, propose a digital banking company? Why do you want to propose a crypto company? Because you're filling a gap in the market, in your opinion. In your opinion, there is a missing gap in the market and you are filling the gap with your product. So what I suggest them is try to find a way to fill that gap and to bring the product into the market without, the usual route and usual rails, that everyone else is doing. So you, for example, talking about digital banking or payment, someone needs to bring money from point A to point B. And usually they do that, for example, sending a bank transfer or paying with their cards. Try to find a way to do the same kind of things in a different way. For example, before MiCAR, it was easier, of course, but stablecoin was a very good example. We had cross-border payments that were very, very complex until 1 year and a half, 2 years ago. You needed, a bank, or most of the cases, 2 banks in order to move money from, for example, Europe to North Africa, and you would need it to be settlements and remittance in different currencies between the two. of them. And in order to do that, you needed a banking license and you needed an e-money license. You needed a third-party provider to settle the two currencies. So a huge amount of money involved, huge amount of people involved. Right now with stablecoins, you can actually do that with the same exact currency, always, for example, trading the same exact, assets with no people involved in the middle. That's the kind of innovation and the kind of workaround that you need into the market in order to be able to solve a problem without following the same path that everyone else is doing. I know that is not easy at all, and in some cases it's not going to be possible, because if you want to propose bank account in the market, there's no way around it. You will need a banking license. So that's basically it. But apart from that, there is always, a very good way to propose a new product, a new innovation into the market without stepping always in the same kind of problems and the same kind of, loop and cycles. So I think that there's no easy answer to that question, to be honest. But there are a lot of very smart people out there that are trying to bring, innovative solution into the market to find a good answer to that question.
Yeah, that's a really deep one. And maybe I would suggest to go backward, because usually the founders, they expert in certain area. And what I've saw as a usual or good examples of the startups and proven business model, when you see inside of the business process that something is missing or can be built more effectively, efficiently, and with a better resource and optimization, or basically the end value for the customers, then it kind of gives an ability to build something without this process trying to find. Because I think a lot of startups, they're not going through the death valley because they assuming that they can find the solution to something which is not possible or already solved to the market by big players. And that leads to the question, because I think if we take a look on the products, even if we compare it to the products, neobanks and digital services 10 years ago, right now, the niches and the gaps, they almost filled. Because if you take a look on big digital banks, they basically becoming the super apps, whatever you would like to find from the financial services or even non-financial services like eSIMs. That's a definitely trend, like your digital bank becoming your go-to vendor or go-to provider for all the needs that you might have. So the retention is better. The marketplace becomes, because in certain applications you can find the hotels, you can have the insurance for the cars, etc., etc., and which narrows down the gaps. What is your feeling about the percentage? What are the issues that still can be solved in digital banking or in digital financial products?
Yeah, I would say in fintech in general, in my opinion, there's still a lot of gaps missing. So a quote that I always hear is that fintech is basically 2% done, 3% done. If we want to digitalize every single financial transaction, and if we want to really, having fintech as the main, financial service, I think that we are still in the very, very early phase. For example, take a look at all the kind of transaction from a financial perspective that you need to do as a company. You have settlement in different currencies, you have banking account in different countries with different employees, with different customers, and you can handle part of those flow with digital transaction. A banking transfer from one bank to another is obviously digitalized and is obviously done in a way that is very modern and innovative, but everything that is around that kind of transaction is still pretty much manual. So you need any way to account for the transaction manually. Greatest amount of companies that I know still do that with Excel, so they're not even using an ERP. So you need to handle the employees that are handling them transaction in a manual way, because still small and medium companies are doing that in a very manual way. So I would say that everything that is revolving around simple transaction and the very basic one in the financial service sector are still very much manual and still very much open for innovation. One of the, let's say, most common example that I found out of this perspective is the flow end-to-end for cross-border payments. So if you're sending, for example, money in foreign currencies right now abroad, and let's suppose that you have a client, I don't know, I'm currently in Italy and I have a client in Egypt, and I'm sending euro to that client, to that customer, that transaction will take a lot of time to arrive. They will need to convert those kind of money. I will need to have the ledger for foreign customers. Everything that is around the transaction that is digital and that is pretty easy to do is still very much manual. It involves a lot of work. You can do exactly the same in a digital world with stablecoin handling the flow end to end, including the accounting, the remittance, the settlement, and everything else. So there is, a push for innovation under that perspective, under that point of view. But still, in my opinion, we are very, very much in the early stage of that process. And there is still a lot of, fields open for innovation out there when talking about fintech.
That's true. And to put another perspective, we have a lot of digital financial services, but we don't have a digital infrastructure for financial services. Like a lot of things are not facilitating or approaching from the old way. Like invoices, we still have all those invoices, even by booking the hotel and then check it out. Everyone is asking, like, would you like the printed invoice? And then you need to account it and put a lot of efforts to maintain for the company. So that's definitely true. And you mentioned the stablecoin, and I'm pretty interested in your opinion from both positions as a product manager and the angel investor, because stablecoin is not just the digital way how to transfer from one point to another point. In my opinion, it shifts the paradigm who's owning value of the assets. Because if we take a look on the current transactions with the banks, the bank is accountable to hold the ledger. They provide you the way. Yes, we have PSD2, PSD3, which is kind of pushing the banks to expose at least the instruments that you're using. But actually, the bank is the holder and basically is the source of truth how much money you have. And if we're talking about the stable coins, there is no one holder, because the network itself gives you an ability to sync nodes to understand what is the wallet's current value. It shifts the paradigm because there is no institution which is accountable for the proper numbers, those numbers across the whole network. Does it change the whole approach how we transact? Because we don't rely on the banks anymore. We rely on the tools which allow to post and see the transactions in these networks.
Well, that is partially true, in my opinion, and I would explain why. So it's actually true that, for example, in a transaction between, let's suppose that you and me want to exchange a stable coin, and we both have a wallet, and we exchange, I don't know, USDT or whatever you want, okay? It's actually true that we don't need a bank in the middle, because I can have a wallet that is from a third party, you can have a wallet that is from a third party, so there's nothing as a banking player in the middle. But at the same time, the kind of value of USDT in that case, or any other company, or any other stablecoin, sorry, it's actually granted by the issuer itself. So in that case, you don't have a bank in the middle, you have Tether in the middle that is actually holding the value of that asset. And behind that kind of player, you have anyway US dollar. In that specific case, you have bond from the US government actually holding the value of that specific asset. So I think that the actual way that they implemented in order to have the value of the stable coin connected to the value of the dollar, for example, in that case, or any other, stable coin in the world, is, shifting a paradigm, yes, but not, revolutionizing the same kind of structure and the same kind of relationship. So you have always someone in the middle that is actually giving, a grant and making sure that everything is safe and everything is, compliant in their perspective. I think that what we saw, for example, in the US with the Genius Act is actually making possible for stablecoin companies and issuer of stablecoins to actually be trusted as financial entities. So what I expect in the future, and we are also seeing that happening right now, because we saw many different kind of banks actually exploring the possibility of issuing their own stablecoins and of using different kind of stablecoins, is the fact that stablecoin providers and some of the crypto companies that we have out there will become financial institutions by any means, So they will not be banks, but they will be different kind of financial players. So I think that is partially true, because in the end, you can actually say, okay, I have my own wallet and you have your own wallet, and we can have a transaction between me and you without anyone in the middle. But at the same time, what are we actually exchanging as a value, because someone out there is granting that value. So I think that it's actually in the middle at the moment.
Yeah, that's true. I was more highlighting the way how we're working with the instruments, because let's assume I have an account in Barclay and I don't have any other way to see the balance and start the transactions, I don't know, in Wells Fargo application, because it's not connected, and it's basically the castles with a quite distinctive separation. And with the stablecoin, it feels like you're able to choose what current or what issuer to use, because we have USDC, USDT, we have a lot of different issuers with a different approach. But in the same way, we're pretty flexible with the tools, which much our cultural approach, I would say, and the needs that the customer have. And another level, or another question that I have, because a lot of people are combining AI and stablecoins as the one path of innovation. So what do you think about the agentic AI and all this movement with the fiat and non-fiat currencies? Isn't going, because right now we don't see good examples of agentic AI. Like, what is your prediction in this area?
I think it's about to come. I mean, stablecoins are already present in the market, for example, but we are again in the very, very early stage of that. So we are seeing an adoption from consumer perspective. We are starting to see a little bit of adoption from corporate and institutions. So we are growing slowly, but on a steady pace, you know. When coming to AI and impact on financial services, I think that one of the first thing that we will see in the market as consumers, so impacting our everyday life, will probably be AI, agentic AI in payments. So having small agents that are able to, for example, finalize the checkout from an e-commerce instead of us, you know, going through the whole checkout. And I see them coming, for example, as integration with OpenAI, so with ChatGPT, but also in other kind of, you know, very, very common tool and popular tool out there. So I think that that will be probably one of the first, you know, tool that we will see as consumer. But AI is impacting the whole financial services sector as it is doing in every other vertical. So I don't think that is more, you know, an option anymore to talk about AI or implementing AI. It's just a matter of how fast are you on implementing that, the kind of approach that you have using AI, and the kind of, you know, wave that you are, you know, riding at the moment that perspective. So just to give you a quick example, in the last couple of months when I was talking with CFO and CTO and CIO of different kind of companies, from smaller startup to established financial institutions, no one actually said, okay, no, we are not using AI, or we are not doing that, or we are not exploring. All of them are actually exploring on how to use AI. Some of them are actually reshaping the kind of structure that they have internally in terms of teams on how to use AI. Some of them are, you know, becoming AI first in terms of development, for example. So the kind of impact will be huge, is already huge. And I think that what we will see first is probably something in payments, as I was saying. Probably then later on something in personal finance assistant is something that I expect to happen from a consumer perspective. So having an assistant that is handling your financial life instead of you know, going through one application, then the other again. So this is something that I expect to be coming, you know, pretty real pretty soon in this market.
I'm always thinking about that because when you're buying something online, usually you have, and that's why we see a rise of the big marketplaces like supply demand. One of the case why Amazon is so popular, because you have kind of the trust for the platform, even though sometimes you have some issues with the quality of the product or et cetera, et cetera. And it brings the question, the trust into the AI, because in this case, you kind of give in, I don't know, maybe the task, buy me the food for the dinner, but you are not limiting, or are we going to limit or control somehow the amount spent and what quality of the products we're going to acquire or buy with this tool? It's a complicated question. I'm always trying to think like how it will go.
It's true, but let me answer in two different ways. So you have a technical solution to that. The technical solution would be, from one perspective, you can actually assign a specific amount to the agent to be able to spend. So for example, let's suppose that I can link my agentic AI for payments to my wallet, you know, and a wallet that I can have in euro, in USD, or for example, also in crypto. Okay, I can allocate a partial amount of that wallet, let's suppose $100, to that agent, and that agent need to manage that amount. So you are safe from a certain perspective. You cannot spend more than $100, and you know that that's the maximum you can lose. At the same time, from a quality perspective, you can actually have that agent learning your taste and your appetite over time. So let's suppose that every Friday you order pizza out there, you can actually be quite sure that on a Friday morning, if you are asking that agent to buy something for dinner, he will probably buy pizza by the time that it's dinner. Okay, so that is the technical answer to that question. At the same time, on the other side, you should ask, for example, yourself, okay, but what about if something goes wrong? Okay, I still remember that there was an old slide from Microsoft in the 90s when they were saying that a computer can never take a management decision because a computer cannot be taken accountable and responsible for that decision. So taking that same concept in today's world, what happens if, for example, one of those agentic AI that I use for payments fail and send money in the wrong direction, or for example, or something that I didn't want it? I cannot take the agents as responsible for that because it's not a person. So I cannot go back to the agent asking back my money. I cannot go back to the company producing the agent because they probably will insert something in the terms and conditions securing themselves for those kind of situations. So that's the problem. Okay, someone missed, my money went in the wrong direction. Whose fault that is? And that's kind of a problem because you cannot blame anyone but yourself, basically. So it's going to be an interesting question in the end of who's responsible for the kind of decision that the agent will take over time. Because you either have two options there. It's either the company producing the agent or it's either you training the agent itself.
So I will hand it as an open, and maybe the last question for today. We had a really fruitful discussion and we covered a lot of topics, but what is the question that I didn't ask today? Is something that you would like to answer to our viewers and listeners of the Fintech Garden, and you think it's important to expose?
In terms of questions, we let's say we had a very interesting overview. I would say something that we could have talked that we didn't is probably the kind of situation that we are in, comparing, for example, Europe to the rest of the world, for example, to the US, to Southeast Asia. So I think that there's a very interesting conversation going on at the moment on what Europe can do in order to speed up the race and be on the same level of other markets in terms of innovation, tech, startup ecosystem, and everything else. And there's a very interesting, thread going on around AU Inc. that is basically having a whole same kind of entity for all Europe in terms of, startup entities, and founding a company that can be available all over Europe instead of having singular, specific regulation. And I'm very pro about this thing, and I would love to see, the European ecosystem thriving and, really skyrocketing in the upcoming years. So this is a very interesting concept, and I would love to hear more people talking about this in the future.
Yeah, that's a good example. Like I didn't tackle the differences between approaches in Silicon Valley and MENA region that we're seeing right now in the European Union. But it's a good point maybe to do another episode, maybe half a year in 9 months, and check what has changed. Because definitely the pace is different. A lot of things are moving really quickly. Like with the stablecoins, with the AI, with the changes, how we are working with the financial products and we working with our customers.